You know what a God candle is, right? It's that massive green bar that appears on a chart seemingly out of nowhere, the kind that makes traders do a double take, the kind that signals something fundamental has shifted in the market, and right now silver just printed one of the most significant God candles we've seen in years. But here's what most people miss about these patterns. They're not random. They're not luck. They're the visible manifestation of something that's been building beneath the surface for months, sometimes years. And when you understand what's really happening behind that candle, you realize we're not looking at a short-term spike. We're looking at the beginning of a major repricing event. Let me show you exactly what I'm seeing, because the implications go far beyond just silver's price chart. Silver just broke through a resistance level that's held for over 3 years. We're talking about the $32 to $34 zone that's acted like a ceiling since early 2021. Every time silver approached this level, it got smacked down. Traders got conditioned to expect rejection at these levels. The market developed muscle memory around this resistance. But something changed. The breakout didn't just pierce through this resistance, it exploded through it with conviction. We're now trading in the high 60s, approaching $70 per ounce. That's not a breakout. That's a breakaway gap. That's the market saying the old rules no longer apply. Now, before we go further, let me explain why this particular God candle is different from the dozens of false breakouts we've seen over the past few years. Because if you've been watching silver for any length of time, you know it has a reputation for head-faking traders. Silver gets everyone excited, breaks out, then crashes back down, leaving a trail of stopped-out positions in its wake. This time, the context is completely different, and context is everything in markets. First, look at what's happening in the physical market. The disconnect between paper silver and physical silver has never been wider. When you go to buy physical silver coins or bars right now, you're paying premiums of $6 to $8 over spot price, sometimes more. That's not normal. In a healthy market, premiums run $2 to $3. When premiums spike like this, it tells you something critical. There's a shortage of physical metal. The COMEX silver inventories have been draining. We've seen over 100 million ounces leave the registered category in the past 18 months. That's metal that was available for delivery, now gone. Where did it go? Into strong hands, into vaults that aren't selling, into industrial applications that consume the metal permanently. And here's where it gets interesting. Silver isn't just a monetary metal like gold. It's an industrial metal with applications that are absolutely critical to the modern economy. Solar panels, electric vehicles, 5G infrastructure, medical devices, water purification. The list goes on, and every single one of these industries is growing exponentially. Let me give you some numbers that should make your jaw drop. The solar industry alone is projected to consume over 200 million ounces of silver annually by 2025. That's nearly 20% of total global silver production. Electric vehicles use about twice as much silver as traditional cars. As EV adoption accelerates, that demand is structural. It's not going away, it's increasing. But here's the kicker. Global silver mine production has been essentially flat for years. We're producing roughly 800 to 850 million ounces per year from mining. That number hasn't grown meaningfully in over a decade. Meanwhile, industrial demand keeps climbing. Investment demand is surging. Central banks in certain countries are accumulating silver alongside gold. You see the problem, right? Demand is growing exponentially, supply is flat, and the above-ground inventories that used to buffer this imbalance are being depleted. This is what creates a God candle. Not hype, not speculation. Fundamental supply-demand imbalances that reach a tipping point. Now, let's talk about what's happening in the derivatives market, because this is where things get really fascinating. The commitment of traders reports have been showing a dramatic shift in positioning. The commercial traders, the big banks and institutions that typically short silver to hedge their physical positions, have been reducing their short positions significantly. Why does this matter? Because these commercials have been the ceiling on silver prices for years. Every time silver rallied, the commercials would pile on shorts, capping the move. They had the firepower to overwhelm the speculative longs and drive prices back down. It was a predictable pattern, but when commercials reduce their shorts, it removes that ceiling. It's like taking the governor off an engine. The price can run without that constant selling pressure pushing it back down. And the speculative traders? They're not even fully positioned yet. The managed money category, which includes hedge funds and large speculators, is nowhere near maximum long positions. There's still massive room for these players to pile in as the breakout gains credibility. Think about what happens when momentum traders see a God candle on the chart. They don't fade it. They chase it. And when you combine momentum traders piling in with commercials not fighting the move and a fundamental supply shortage in the physical market, you get the conditions for a sustained bull run. Let me take you back to 2010 and 2011 because there are some eerie parallels to what we're seeing now. Silver was trading around $18 in late 2010. Within 6 months, it had rocketed to nearly $50. That's a 175% gain in half a year. What drove that move? It was a combination of factors remarkably similar to today. You had quantitative easing from the Federal Reserve, which was debasing the dollar. You had concerns about sovereign debt in Europe. You had investment demand surging as people looked for inflation hedges. And you had a supply-demand imbalance in the physical market. Sound familiar? The difference between then and now is that the fundamental case for silver is actually stronger today. The industrial demand story in 2011 was nowhere near as compelling as it is now. We didn't have the green energy revolution. We didn't have the EV boom. We didn't have 5G infrastructure being built out globally. And here's something most people don't realize. The 2011 peak in silver was driven primarily by investment demand. It was a monetary play. When that speculative fever broke, silver crashed because the industrial demand wasn't there to support those prices. Today, we have both. We have the investment demand coming back as people wake up to inflation and currency debasement. But we also have this massive industrial demand that's structural and growing. That creates a much more stable foundation for higher prices. Now, I want to address something important here. Because if you're thinking about your financial future, your retirement security, this matters. A lot of people hold their wealth in traditional assets, stocks, bonds, maybe some real estate. And there's nothing wrong with that. But when you see a God candle appear in a commodity like silver, it's often a signal that something is shifting in the broader financial system. Quick aside here. If you're sitting on a significant retirement account, $100,000 or more, and you're concerned about inflation, currency debasement, or the stability of traditional financial assets, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. All right, back to what's happening with silver and why this God candle is just the beginning. Let's talk about the gold to silver ratio, because this is one of the most important indicators in the precious metals market. Historically, this ratio has averaged around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. During the 2020 panic, this ratio spiked to over 120 to 1. Silver was incredibly cheap relative to gold. Right now, we're seeing this ratio compress rapidly. As silver outperforms gold, the ratio is falling, and history shows us that when this ratio starts to compress, it tends to overshoot to the downside. We could easily see this ratio fall to 40 to 1 or even 30 to 1 in a strong silver bull market. What does that mean in practical terms? If gold is trading at $2,600 per ounce and the ratio falls to 40 to 1, that puts silver at $65. If the ratio falls to 30 to 1, that's $86 silver. And that's assuming gold stays flat, which it won't. If gold rallies to $3,000 or higher, which many analysts expect, you can do the math on where silver could go. But here's what really keeps me up at night, in a good way. The above-ground silver inventories are at multi-decade lows relative to annual consumption. In the 1990s, there were billions of ounces of silver sitting in government stockpiles. The U.S. had a strategic silver reserve. That's all gone. It was sold off years ago. Today, the visible silver inventories in exchanges, ETFs, and reported vaults total maybe 2 billion ounces. That sounds like a lot until you realize that annual demand is approaching 1.2 billion ounces. We're talking about less than 2 years of supply sitting above ground, and a significant portion of that is in ETFs and allocated storage, meaning it's owned and not available for sale. Compare that to gold, where above-ground stocks represent decades of annual production. Gold is abundant. Silver is becoming scarce. And here's the thing about scarcity. Markets can ignore it for a while. Prices can stay irrational longer than you'd expect. But eventually, scarcity asserts itself. And when it does, the repricing is violent and swift. That's what a God candle represents. It's the market waking up to scarcity. Now let's talk about what the smart money is doing, because this is always instructive. Central banks have been accumulating gold at record pace. Everyone knows that. But what's less discussed is that several countries are also building silver reserves. China, Russia, India. These aren't small players. These are countries that understand the strategic importance of silver in the technology and defense sectors. When a country decides silver is strategic, they don't buy a few million ounces, they buy hundreds of millions. And they don't sell. This metal goes into vaults and stays there. It's removed from the available supply permanently. The ETF flows are also telling. After years of outflows, we're seeing money pour back into silver ETFs. The largest silver ETF, SLV, has seen consistent inflows for months. That's institutional money. That's pension funds and endowments starting to allocate to silver. These are slow-moving elephants, but once they start moving in a direction, they don't stop quickly. And then there are the mining companies. This is where it gets really interesting from a supply perspective. Silver mining is often a byproduct of other mining operations. About 70% of silver comes as a byproduct of copper, lead, and zinc mining. Only 30% comes from primary silver mines. What does this mean? It means silver supply is relatively inelastic. Even if silver prices double or triple, you can't just turn on more silver production quickly. You'd need to build new mines, which takes years and hundreds of millions in capital. Or you'd need copper and zinc prices to rise enough to make those base metal mines more profitable, which would increase silver byproduct. But here's the catch. The easy silver deposits have been mined. The ore grades are declining. It's getting more expensive to produce silver, not cheaper. The all-in sustaining costs for primary silver miners are approaching $20 per ounce. Some operations are higher. That puts a floor under prices. But more importantly, it means that even at $30 or $35 silver, the profit margins for miners aren't huge. There's not this massive incentive to flood the market with new supply. This is completely different from something like oil, where high prices quickly bring new production online. Silver doesn't work that way. The supply response is slow and limited, so you have surging demand, constrained supply, depleting inventories, and a market that's been underpriced for years. That's the recipe for a major bull market. And the God candle we just saw is the market's way of saying, the old equilibrium is broken. We're repricing. Let me give you another historical parallel because this one is really instructive. In 1979, silver was trading around $6 per ounce. Within 18 months, it had rocketed to $50. That's an 8x move. What drove it? Part of it was the Hunt brothers trying to corner the market, sure. But that's not the whole story. The real driver was inflation panic. The dollar was losing value rapidly. Interest rates were skyrocketing. People were desperate for stores of value. And silver, being more accessible than gold for average investors, became the vehicle of choice. We're seeing echoes of that today. Real interest rates, after adjusting for inflation, are negative or barely positive. The purchasing power of the dollar has been eroded significantly over the past few years. People can feel it in their grocery bills, their rent, their energy costs. And when people lose faith in the currency, they look for alternatives. But here's what's different now. In 1980, when silver hit $50, there was no industrial demand story. Silver was purely a monetary metal. When the speculative fever broke and the Hunts were forced to liquidate, silver crashed because there was no fundamental support. Today, even if investment demand wanes, you have this massive industrial demand that's growing every year. Solar installations aren't going to stop. EV production isn't going to stop. 5G build-out isn't going to stop. That demand is there regardless of what speculators do. This creates a much more sustainable bull market. You're not relying solely on sentiment and speculation. You have real, tangible demand from industries that need silver to function. And let's talk about the geopolitical dimension, because this is becoming increasingly important. We're in an era of deglobalization and supply chain reshoring. Countries are realizing that being dependent on other nations for critical materials is a strategic vulnerability. Silver is a critical material. It's essential for defense applications, for technology, for energy infrastructure. Countries that don't have domestic silver production are going to need to secure supply through long-term contracts or strategic reserves. That's additional demand that's going to compete with industrial and investment demand. China controls a significant portion of global silver refining capacity. If geopolitical tensions escalate, if trade restrictions are imposed that could create supply disruptions for Western countries, the market is starting to price in these risks. Now let's talk about what happens next, because this is what everyone wants to know. Where does silver go from here? Technical analysis suggests the next major resistance level is around 35 to 36. That's the 2011 high. If silver breaks through that level with conviction, there's not much resistance until you get to $50. That's a psychological level, but it's also where silver peaked in 1980 and 2011. Breaking $50 would be a massive statement. But here's what I think people are missing. The fundamental case for silver is stronger now than it was at either of those previous peaks. The supply-demand imbalance is more severe. The industrial demand is more robust. The monetary environment is more favorable. If silver breaks $50, I don't think it stops there. I think we could see $75 to $100, maybe higher. And I'm not alone in this view. Some of the most respected analysts in the precious metals space are calling for triple-digit silver within the next few years. Is that guaranteed? Of course not. Markets are unpredictable. There could be a recession that temporarily crushes industrial demand. There could be a surprise discovery of a massive silver deposit. Central banks could tighten monetary policy more aggressively than expected. But when you look at the balance of probabilities, when you weigh the evidence, the case for significantly higher silver prices is compelling. And here's the thing about God candles. They don't appear at the end of moves. They appear at the beginning. They're the market's way of signaling that a new trend is starting. The breakout has happened. The resistance has been conquered. Now it's about how far the move can run. For traders, this is about momentum and position sizing. For investors, this is about allocation and time horizon. But for everyone, this is about recognizing that something fundamental has shifted in the silver market. The God candle isn't just a technical pattern. It's a message. It's the market telling you that the old rules no longer apply, that the ceiling that held for years has been shattered, that we're entering a new phase. And if history is any guide, these new phases in silver can be explosive. They can generate life-changing returns for those positioned correctly, but they can also be volatile and challenging for those who don't understand what they're holding or why. The key is to understand the fundamental story, to know why you own silver, to have conviction based on evidence, not emotion, because there will be pullbacks. There will be days when silver drops 5% or 10% and the headlines scream about the bubble bursting. That's when weak hands get shaken out. That's when people who bought based on hype sell at a loss. But if you understand the supply-demand dynamics, if you understand the industrial demand story, if you understand the monetary environment, those pullbacks become buying opportunities, not reasons to panic. The God candle that just appeared in silver is telling you something important. It's telling you that the market has recognized the imbalance, that the repricing has begun, that we're in the early stages of what could be a historic bull market. The question is, are you paying attention? Are you positioned? Or are you going to look back in a year or two and wish you had acted when the signal was clear? Because here's the reality. God candles don't appear often. When they do, they mark inflection points. They mark the beginning of major moves. And the traders and investors who recognize them early, who have the courage to act on what they're seeing, those are the ones who capture the bulk of the gains. Silver just gave you a signal, a clear, unmistakable signal. What you do with that information is up to you. But don't say you weren't warned. Don't say you didn't see it coming. The God candle appeared. The message was delivered. Now it's about execution.